What if everything we've ever been told about financial stability is a calculated illusion, a performance engineered to keep you calm while the real danger grows in the shadows? What if the date everyone fears, the one analysts dance around, the one central banks deny even exists, is already locked in by a mechanism they can control? And what if that date isn't some distant, hypothetical apocalypse, but 2026, the year the system finally meets math it can't outrun? Because here's the truth most people feel, but can't articulate. Your paycheck buys less. Your rent rises faster than your income. Your savings erode. The rules keep changing, but never in your favor. And every time politicians promise soft landing, inflation relief, or sustainable debt, your life somehow gets harder. Sound familiar? It should, because none of this is random. It's the symptom of something bigger, a pressure building underneath the global financial system, invisible but fatal. Today, you're going to see the architecture of that pressure, the real engine behind the next crash. But before we dive in, quick check-in: where are you watching from? This channel is building a global community of critical thinkers, and if you're tired of sugar-coated headlines and want the unfiltered truth, hit subscribe now. Because everything you thought you knew about 1929, 2008, or even the COVID financial response is about to get shattered. Let's rewind. Financial historians love to treat every crisis as an isolated event, a random accident caused by irrational exuberance or market panic. But when you stack the patterns side by side, the truth is painfully clear. 1929, the illusion of endless growth. Before the Great Depression, America was told the economy had reached a permanent plateau. Newspapers wrote about a new era of prosperity. Brokers encouraged ordinary people to borrow money to buy stocks on margin. Banks blended speculation with consumer deposits. The Federal Reserve promised stability. Sound familiar? The crash didn't come from thin air. It came from leverage. Layers of baits placed on top of borrowed money, all assuming markets would rise forever. When they didn't, everything collapsed. Now jump forward. 2008, the mortgage mirage once again. Everyone was told the system was safe. Once again, debt was packaged, repackaged, sliced, and insured. And once again, no one understood the real level of risk. Mortgage-backed securities, CDOs, synthetic CDOs. It was financial engineering masquerading as innovation. In 2007, the value of global derivatives exceeded 10 times global GDP. Sound familiar? Because once again, the baits grew bigger than the real economy. And once again, collapse was mathematically inevitable. When the housing bubble cracked, the entire system shook. Not because houses fell in value, but because the derivative baits linked to those mortgages created a global chain reaction. Banks didn't fall because of bad loans. They fell because of bad baits. Now, here's the twist. 2022-2024, the age of unlimited liquidity. Pandemic stimulus created the largest money injection in human history. Central banks flooded markets with liquidity. Governments issued debt at historic speed. 0% rates made borrowing practically free. And what did the financial sector do with that cheap money? They didn't lend it to small businesses. They didn't raise wages. They didn't build affordable homes. They leveraged it into derivatives, interest rate swaps, currency swaps, volatility derivatives, commodity-linked futures, synthetic debt structures, an entire alphabet soup of financial engineering. Today, the global derivatives market is $100 trillion. It's not $500 trillion. The Bank for International Settlements estimates notional exposure at over $2 quadrillion. Let that sink in. A quadrillion is 1,000 trillions. The numbers are so large they stop feeling real. Sound familiar yet? But here's the critical parallel everyone misses. 1929 collapsed because leverage outgrew regulation. 2008 collapsed because derivatives outgrew oversight. 2026 will collapse because derivatives have outgrown reality itself. The same patterns repeat, but each time, the stakes get bigger. The speed gets faster, and the shockwebs become global. We are no longer dealing with national bubbles. We're dealing with an interconnected global web that cannot fail in one place without failing everywhere. Because the financial system isn't just gambling on stocks or mortgages, it's gambling on interest rates, currencies, sovereign debt, corporate defaults, inflation, energy markets, and even the volatility of volatility. The crash of 2026 in a prediction. It's inertia, a train that cannot stop because the rails were built from the same material that caused every major crash in history. Unregulated leverage disguised as innovation. Here's where the story gets darker, and where the conspiracy stops being a theory and starts looking like a blueprint. Because after 2008, regulators promised never again. They claimed derivatives would be tracked, cleared, and controlled. But behind the scenes, something else happened. Big banks found a way to keep the derivative machine alive by moving it into the shadows. Enter the shadow derivatives liquidity web, a network of over-the-counter trades between megabanks, hedge funds, sovereign wealth funds, central banks, and private liquidity pools. These trades are not on public exchanges. They are not fully reported. They are not stress-tested. They don't appear on balance sheets in ways normal people can read. They exist on private contracts, often with foreign counterparties, using offshore legal structures and cross-border swaps. This is where the real risk lives. And the key moment, the moment the fuse was lit, didn't happen in 2008. It happened quietly in 2019, when the US repo market seized up and the Federal Reserve injected $75 billion in a single day just to keep the system functioning. That emergency, the one most people never heard about, exposed the truth. Banks couldn't trust each other's collateral anymore. So, instead of fixing the problem, they doubled down. They expanded the shadow web. They shifted risk off books into a place regulators can't reach. And at the center of this web is a single institution, one that holds more derivative exposure than the GDP of most continents. You won't believe the name, and the receipt is wilder than you think. The shadow derivatives liquidity web. Explained simply, imagine the global financial system as a network of people standing in a circle, each holding hands. If one person falls, the circle tightens and shifts. It can withstand a stumble. But now imagine each person also tied to 10 others outside the circle by invisible ropes. That's derivatives. Banks don't just owe money to customers, they owe money to each other in complex, synthetic contracts that bet on everything from interest rates to corporate bankruptcies. And here's the shocking part, the vast majority of these contracts offset each other. Until they don't. Why this system is fragile. Derivatives are supposed to hedge risk. But the more they hedge, the more leverage they create. It's financial Jenga. Example, Bank owes Bank B $10 billion if interest rates rise. Bank B owes Bank C $10 billion if the dollar weakens. Bank C owes Bank A $10 billion if corporate defaults increase. Individually, each bet can look safe. Together, they form a circular dependency. If one fails, all fail. Now scale that from $10 billion to $500 trillion in interest rate swaps alone. Now add currency swaps, credit derivatives, commodity derivatives. This is not a system, it's a pressure chamber. The 5 shocking statistics that define the risk over $2 quadrillion notional exposure, more than 20 the entire global economy. 97% of derivatives concentrated in just 5 US banks per OCC data. $188 trillion in interest rate derivatives held by a single institution. Public filings. $1.4 trillion growth in derivatives exposure in 2023 alone. During a stable year. $80 trillion in dollar-denominated obligations held offshore with no public accounting. This isn't a bubble, it's an engineered illusion. The role of 2026. Why 2026? Because 2024 to 2025 transition years in global debt cycles. U.S. Treasury refinancing spikes into 0 to 5 to 0 to 6. Corporate debt maturities surge by $2.3 trillion. Commercial real estate resets over $1.5 trillion. Global interest rate swaps expire and roll over. Multiple central bank currency swap lines end. In other words, 2026 is the year the rollover wave arrives, when debt must be refinanced at the new, higher interest rates. The shadow web wasn't built for high rates, it was built for zero. Why high interest rates break everything. Derivatives pricing relies on stable interest rates. When rates rise, hedging costs explode, margin calls increase, liquidity evaporates, counterparty risk skyrockets. In 2008, margin calls hit mortgage securities. In 2026, margin calls will hit the entire derivatives web. The domino effect, how the collapse spreads. Step 1. A major institution misses collateral requirements, just like Lehman, but larger. Step 2. Counterparties freeze credit. Banks stop lending to each other overnight. Step 3. Liquidity demand spikes over 1,000%. This already happened in March 2020. The Fed injected $1 trillion per day to backstop repo markets. Step 4. Central banks attempt emergency swaps, but this time, the exposure is too large. Step 5. Derivative contracts unwind violently. When one bank fails, its obligations transfer to counterparties. Those counterparties fail. The chain reaction begins. Why 2026 is worse than 1929, plus to 0819-9 was national. 2008 was international. 2026 will be instant and global. Because everything is connected. Bonds, currencies, commodities, swaps, mortgage debt, corporate debt, sovereign debt, private equity loans, repo markets. This is not one market collapsing. It's all markets collapsing simultaneously. The moral hazard for decades. Banks operated under the assumption that central banks would always bail them out. This created moral hazard, the belief that risk doesn't matter because someone else will pay. But the numbers have grown too big. You can bail out $700 billion. You can even bail out $7 trillion, but you cannot bail out the dollars quadrillion. The system has passed the point of rescue. It now runs on momentum and denial. Here's the real danger. Every previous crash unfolded in slow motion. 1929 took months. 2008 took weeks. But the structure of today's financial system, digital, automated, leveraged, interconnected, means the next collapse will be instantaneous. One failed margin call in Tokyo becomes a liquidity freeze in London, becomes a credit halt in New York, all within hours. In 1929, panic traveled by newspaper. In 2008, panic traveled by television. In 2026, panic will travel by algorithm. The illusion of stability, the stocks hitting all-time highs, the political promises, the central bank reassurance, is built on borrowed time. And borrowed time eventually comes due. The deeper lesson, denial is expensive. And trusting institutions that depend on leverage, illusion, and secrecy is even more expensive. The truth is simple, we are not heading toward a correction. We are heading toward a reckoning built not on greed alone, but on a system that forgot the one rule you can't violate. Reality always wins. If you felt something in this video, a sense that the cracks you see in your own life connect to something bigger, then share this with someone who still trusts the headlines. And if you're new here, hit subscribe. This community doesn't run on blind optimism, it runs on clarity. Because the question we all need to ask now is, are we wiser today, or walking the same path in better suits?